What's good, everybody? Hope you guys are doing good. So today I'm going to go over a few stocks that have cut their dividend in April. So the first one here is Western Digital. You guys have probably heard of this one already. So it's mostly a stock that has to do with data center and hard drives. You guys might even have an external hard drive from Western Digital. So right over here I'll explain briefly what they do. Western Digital is a developer, manufacturer, and provider of data storage device and solution. Let's see, client devices, which consist of hard drives and solid state drives for computing devices, flash-based embedded storage products and flash-based memory, wafers and components, data center devices and solutions. So basically they make hard drives and internal storage. You get the idea. Look at this. Their dividend history chart has been decent since 2012. They've been paying a dividend. But since it looks like about 2015 to current time, they haven't raised their dividend, but at least it's consistent, so that's a good thing. And it has a market cap of almost 14 billion, which is pretty good. But Western Digital reports revenue beat, suspends dividend. So they fall about 5.3% after opening. A FQ3 revenue beat and EPS missed for the period ending on March 29th, with featured little bug damage. Notebook solutions had greater than expected demand due to the remote work shift, which brought desktop solutions down. Smart video hard drive demand was also slow. Mobile flash bit shipments remained modest. As we can see here, they were down, and right here it says WDC is suspending dividends to improve its leverage ratios. And over here on dividend safety, they had about a borderline safe, which is, I guess, the average. Dividend yield was pretty good though, 4.34%, but it says volatility very high. Luckily, I do not own any Western Digital. I will admit though, I was looking at it since it was trading pretty low, but after this news, I'm not going to get anywhere near this one, guys. Once they cut their dividend, I try to keep my distance. Alright guys, the next stock to have a dividend cut is Dunkin'. I'm sure you guys have all heard of Dunkin'. They got some pretty good donuts, and their slogan is, I think, America's favorite donuts, or America runs on Dunkin', something like that. There you go, always on the run. Yep. So Dunkin' Donuts, everyone loves it. We all go there once in a while. And they have officially cut their dividend. So this is from Seeking Alpha. Dunkin' Brands misses comparable sales mark, pulls dividend. Dunkin' Brands, ticker symbol DNKN, reports a 2% drop in comparable sales for the Dunkin' Donut chain in the US versus negative 1.3 consensus. The negative comp came after a growth of 3.5% in the first 10 weeks of the quarter, was offset by a plunge of 19.4% in the last 3 weeks of the quarter. International comparable sales fell 7.1% during the quarter versus negative 2.8% consensus. The company operating margin came in at 33% of sales versus 32.5%, so 32.8% and 32.5%. And here we go, this is the news. Dunkin' Brands suspends its regular dividend program, which it says will result in cash savings of approximately $33 million in Q2 to reinforce an already strong balance sheet. See, I don't like this news, guys. You don't cut your dividend if you have a strong balance sheet. It doesn't make any sense. This is where you got to use your thinking hat here, guys, and say, okay, does this make a whole lot of sense? Do you cut to save? It doesn't make sense. You can do other things besides cut your dividend. Dividends are the last thing you want to cut because people really like the dividends. Everyone likes to sit back and wake up in the morning and get that notification they got paid a dividend. This does not help. So shares are down 1.85%. Let's go take a look at it more in detail. I don't have to really go over what Dunkin' is. You guys know what it is. I just went over it. So here, this is pretty solid. This is what you want to see from a dividend company. It keeps on increasing since 2012. 5.16 billion market cap, which is pretty small. But as you can see, it kept on raising as time has gone on. Over here on Simply Safe Dividends, the price had dropped about 3% today. market cap 5 billion, and the volatility was high. But it did have fast dividend growth. So this was one that, I gotta be honest again, I was considering this one too, because I like Dunkin' Donuts. Who doesn't like donuts? But fortunately, I did not get with this one. Alright guys, so the next stock is Harley Davidson, another one that I'm pretty sure you guys have all heard of. They're famous for their motorcycles. Harley Davidson is an American motorcycle manufacturer founded in 1903. It was one of two major motorcycle manufacturers to survive the Great Depression. Currently the stock is $21.83. Dividend yield has been destroyed again. Look at that. 0.37. That's not good. Market cap of only about 3 billion. The news. Dividend, I don't know if I can say this word or not. So dividend cut in this crisis is already breaking records, but it just started. Okay, right over here, this sums it up. Dividend yield can be an irresistible siren song in the era of central bank interest rate and bond yield repression. Harley Davidson's ticker symbol HOG. Quick disclaimer, I do not own Harley Davidson. Do not. Negative. Not me. Dividend yield was over 7% until this morning when it announced that it would slash its dividend by 95% from 38 cents to a symbolic 2 cents to conserve cash. Going forward, the dividend yield will be close to zero. There you have it, guys. Harley Davidson, a well-known company I'm sure people are invested in. Dividend growth, very slow. Dividend safety, unsafe. Almost 7% though, that was a good number. And their price was pretty cheap. Like I said guys, this is one that on the surface it looked pretty good. Dividend growth, past 20 years, very fast. Past 5 years average, their chart is looking pretty good. 10 years, they have gone without a dividend cut. 9 years of consecutive increases. But you gotta really pick and use your gut instinct to decide if you feel strongly about the company or not. For me, the reason why I didn't want to get involved with Harley Davidson is because it's too much of a niche business that I don't feel too comfortable with. Motorcycles, it's not something people really need every day and they're gonna buy to the extent that I like, and their market cap isn't enough for me to want to invest. So I did not get anywhere near this for that specific reason. Okay, on to the next one. Alright guys, so the next stock we have is GM, General Motors. I'm sure all of you have heard of them. One of the biggest car manufacturing companies. General Motors Company, commonly referred to as General Motors, is an American multinational corporation headquartered in Detroit that designs, manufactures, markets, and distributes vehicles and vehicle parts and sells financial services with global headquarters in Detroit. Currently, it is $22.29. Dividend yield was 6.82%. PE ratio of only 4.87. Market cap 32 billion. So this is a large cap company, guys. Let's go look at their numbers over here. Pretty solid dividend history. Their growth hasn't been great from about 2016, but at least they're paying. They haven't been cutting. As you can see the chart over here, since 2014 they have been paying their dividend. And as I said earlier, market cap of 32 billion, which is good. Now let's go over here. As you guys can see, GM suspends dividend as shutdowns continue and recession looms. All right, let's read some more. Over here, let's go. Okay, this is as of April 27th, so this was only a few days ago. GM suspends its dividend today to preserve cash amid extended production shutdowns and uncertain economic conditions. On April 17th, we downgraded GM's dividend safety score to borderline safe to unsafe and published a note analyzing the automaker's financial position and short-term outlook. And this is what the management had to say. GM has extended $3.6 billion under its 3-year revolving credit agreement to April 22 to further strengthen its liquidity position. This complements the extension of the $2 billion 364-day revolving credit agreement on April 2021 that GM and GM Financial renewed earlier this month. And this is the news right here, guys. In addition, the company has suspended the quarterly cash dividend on its common stock suspended its share repurchase program and has taken other significant austerity measures to preserve near-term available cash. As I've been saying, and the common theme throughout this video, I'm trying to get you guys to really understand. On paper, GM looks good. They're a well-known company. They have a good market cap, 32 billion. The price is cheap. The dividend has looked relatively safe. However, they cut their dividend. So you must really use your judgment, guys. And do you feel strongly about the business that they're not going to cut? Like I said, for me personally, I do not have automotive stock besides Tesla, and I have a very, very small position in Tesla. This is why I'm not really too comfortable with automotives. I'm just not. I don't want to invest in it. Hence, I stay away from GM. But a lot of people have recommended. So there you have it, guys. That is GM, and they did have a high volatility as well. On to the next one. Alright guys, so the next company is Las Vegas Sands. They're a casino hotel company. Las Vegas Sands Corporation is an American casino and resort company based in Paradise, Nevada, United States. Resorts feature accommodations, gaming and entertainment, convention and exhibition facilities, restaurants and clubs, as well as an art and science museum in Singapore. Currently trading at $48 per share, market cap of $37 billion. So this is a pretty decent sized cap, guys. Dividend yield was almost 7%. Let's go to the news. Okay, right over here, guys. Sands, which suspends its dividend payment due to the bug impact, is bleeding nearly $4 million a day in operating costs. However, with cash reserves around $1.4 billion, it can keep going for 2 years without any revenue, said DS Kim, an analyst at JP Morgan in Hong Kong. Okay, this is important news. Sands chairman Sheldon Adelson said any resumption in dividend payments would depend on income going forward. I assure you I have not said yay dividends and yay buybacks for the last time, Adelson said during an investor call following first quarter results on April 22. Sands reported 166 million quarterly net loss. And it says here, all the deals that we have seen in Asia have been in sectors where there have been visibility on what the future will look like. We don't know when people are going to be able to go to Macau again. And their chart was pretty decent since 2012. They've been paying dividends. They've been raising them at a pretty small rate, but at least it was increasing. And yep, since 2012 they have been paying, and it has been increasing over time. But it did have a high volatility. Like I said, 37 billion large cap, $48 a share. The chart over here, it had very fast, well I shouldn't say very fast, but fast dividend growth the last 5 years. And their financials look pretty decent from what I'm saying for the most part. But recently their sales did take a hit. Again guys, this was one that I was looking at because people love to go to casinos. Las Vegas is a hot spot, but right now obviously nobody's traveling and these guys are taking a hit. And this is where it's conflicting because they're telling us over here that they have enough to be okay, but they had to cut their dividend. So you got to ask yourself, what's really going on? Why would you cut your dividend? That's the last thing you want to cut, guys. It's another theme I keep on telling you guys, is you do not cut dividends. People love their dividends. That's free money right there. Everyone loves free money. Sorry guys, I get a little bit passionate about these things. I was looking at them though. I'm going to be honest with you guys. I was looking at them heavily. Fortunately, I did not buy them. But yeah, even the big guys go down. And for my last stock, you guys probably know which one it is. This one, every single person owns for the most part, and we all just got destroyed today. Okay, on to the last one. Alright guys, and the last company that has cut their dividends so far is Goliath, the giant himself, Royal Dutch Shell. Royal Dutch Shell cuts dividends for the first time since World War II. This was the worst news I heard all day today, guys. I do own Royal Dutch Shell, the only one on this list that I own. 125 billion market cap, 8.48 PE ratio, down 13%, and they cut their dividend. It's almost 11.35, almost 12%. Why? Why they gotta cut it, guys? let's go over here. Dividend growth was slow. It was borderline safe, but they reduced dividend in response to unprecedented uncertainty facing the oil market, guys. So even the biggest, the baddest of them all has to make cuts sometimes. And look at this, guys. They had solid dividend growth. This was terrible news. Almost $1 a share, and they've been paying out for quite some time. So, like I said, I don't want to harp too much on this one, guys. It kind of hurts. This one hurts because I had a nice amount in these guys. So there you go. Even the giants can go down sometimes, guys. All right, I think we'll be okay, guys. I think we'll be okay. Hopefully you diversified. If not, you're gonna learn after this. You gotta diversify. Anyways, that's gonna be the next videos, guys. As always, if you're not subscribed, don't forget to subscribe. And if you like the video, don't forget to give it a like. Until next time, peace. Oh, jeez, they cut their dividend.